Hello everyone and good morning. Sorry for interrupting, but you've already had your coffee, so let's get this underway. You are at the panel entitled Monetary Policy Innovations for Funding UBI. I'm just the chair, Gustav Peebles, from here in the neighborhood of the New School, and these are going to be 15-minute presentations followed by Q&A after all of them. And we will begin, I believe, right with Helen Kmera.
I was a lifelong social worker and now I'm retired, and I must say retirement is amazing. Way better than social working. I'm also from Ontario, Canada, so my talk is going to be about the Canadian situation. All of us sitting here are advocates for monetary reform. We're all on side for a universal basic income, but we want to see it done differently, not through taxation and borrowing, but through a system we'll be describing kind of as we unfold. So my presentation will discuss the idea that relying on bank credit indirectly through taxation or directly through borrowing to fund a UBI scheme is not tenable. We're advocating for monetary reform as advocated by Douglas social credit about 100 years ago. This idea is not new, so we'll be talking about that. Under Douglas social credit, each citizen would receive a UBI without taxation and without government borrowing and government debt. So my presentation will look at the problems of, as we have it, the current system in funding a universal basic income scheme using taxation. So in our current framework, it's a fact that we can't afford a UBI. Paying each Canadian adult $1,000 per month would cost us in Canada $322 billion, and all federal spending in 2017 was nearly that amount. Even with savings that would be gained by collapsing the existing patchwork of our social welfare programs, the increased costs in taxes to implement a UBI really staggers the imagination. It keeps us on this side of the solution. Taxation and government spending already has its problems. I'm not a fan of taxation, so that's what you're going to be hearing about. It is not likely that after a UBI scheme is in place that tax dollars will always be spent soundly and soberly in a way that favors community interests rather than special and partisan interests. Taxes already take a good portion of a person's purchasing power. In fact, Tax Freedom Day was yesterday for Canadians, or 2 days ago. Was it yesterday? So from now on, for the rest of the year, we're working for ourselves and not for funding government revenue, which is it's a little bit different in the States, but we have high taxes in Canada. Future prosperity is compromised because of deficit spending, borrowing, and national debt. Knowing the impact that automation is having in the economy, can we turn to corporate Canada and America to fund the basic income when the global economy and tax havens allow for easy corporate relocations? And finally, does the relatively generous redistribution of tax income in place today in Canada solve our social problems? And is it realistic to think it will in the future? It's not just the super rich who are paying taxes. At upper levels, taxes are downloaded into prices, and everyday consumers bear their cost. The burden is significant and growing for individuals and families. The Fraser Institute in Canada determined that the total tax bill for the average Canadian family has increased by 2,112% since 1961. Okay, I've got another page there. Sorry. Taxes have grown more rapidly than any single expenditure in a family's budget in the intervening 60 years. It seems that everyone pays taxes on almost everything already, yet personal income tax was introduced as a temporary measure only in both Canada and the US about 100 years ago, was set at a level that affected very few people. In its original form, Canada's tax code was 11 pages long, and now a century later, it is more than 200 times that length. We have provincial and municipal taxes, also of course that add additional burdens, and every day new spending is announced. One of the problems with all this tax collection and government spending that can be odious for some of us is that the individual forfeits the ability to support causes important to him or her and is forced to support causes that may be repugnant. Still, governments continue to find new things to tax and increase existing taxes. Right now, a surcharge on soft drinks is proposed in Canada. This week, business owners in Calgary rallied because property taxes had spiked by almost 45% in 1 year. And Canada has introduced a relatively controversial carbon tax, despite opposition from several of the provinces, that has been quite staunch. And it's going to cost the average rent family an additional $258 in taxes this year, with annual increases forecast in fact. The cost for the same family by 22-23 will be $648. I'm proposing we'd be freer and happier if the tax lash and its reach was light rather than so severe, but unfortunately it is not so. As I said, Tax Freedom Day was yesterday, and taxes in Canada take almost 45% of an annual income. Many are implicated in the tax system. Not only does everyone pay taxes, but many are commissioned as unpaid tax collectors, including manufacturers, employers, merchants, retailers, utility providers, restaurant and gas station owners, etc. Our Western societies hold dear the principles of transparency and accountability, but the tax system is the opposite. It's complex and incomprehensible. The tax system focuses our attention on how to lighten the burden of taxes and hold on to more of our incomes rather than on the enjoyment of life. There's the tyrannical element as well, with the state threat of fines and more for tax evasion. There are no options to sit on the sidelines. We all have to play this game. Clearly, a UBI scheme of some sort will be essential if the ordinary person is to have any purchasing power, as automation continues to render many occupations redundant. Governments will have a tough time funding a UBI by redistributing tax dollars while the working tax base has been so reduced. And an Oxford University study estimated that 47% of jobs can be automated from a technological capability point of view and will be eliminated within 25 years. And another forecast is that by 2030, 80% of jobs that pay $20 or less per hour will disappear. We have to wonder not only who will be the tax base in the new economy, but how will a shrunken workforce feel about their tax obligations? Given that taxing the fraction of the population who will still have jobs to support the remaining number is a problem, we must ask if we should increase tax revenue from corporate profits and hone in on the super rich to fund a UBI. But will we drive both out of the country if we try? High marginal personal income tax rates are disincentives for earning more and incentives for skilled and highly paid workers to leave the country. The same is true for corporations. In a global economy, high corporate tax rates and high infrastructure costs result in corporate relocations. Although initially governments do gain revenue from increasing taxes, the jurisdiction eventually loses when head offices, capital equipment, jobs, and the tax base is gone. My home province of Ontario has the second highest combined tax rate of the 61 jurisdictions in North America and has the highest cost for hydroelectricity. Given a choice, these are not conditions that attract or keep businesses and manufacturers in our midst. As a result, the province, once the country's economic engine, is not what it used to be. The last thing I'll just touch on is whether redistributing tax dollars from Peter to pay Paul will increase Paul's influence on public policy and shift his marginalized position in society. Can palliative measures funded by taxation achieve the goals of justice for everyone? If we can't afford a UBI, which is true in the current financial and monetary framework, will a more limited scheme correct the issues of poverty? 50 years ago in Canada, the Kroll report recommended a limited guaranteed annual income to address poverty. And despite generous tax transfers to low-income Canadians since then, In 2011, Canada ranked 21st out of 27 OECD countries in terms of poverty levels, with 1 in 7 qualifying as poor. To date, income redistribution hasn't solved the problems of poverty, and although poorer Canadians pay less in income tax, they pay a greater proportion of their incomes in other forms of taxation. Lower income Canadians, though, wield little political power and do not significantly influence the social landscape. It is likely that a targeted basic income will not fix the problems of power, and a class divide will remain. Or else government will keep cobbling together more and more tax-funded programs to shoot for these goals. I guess I've got one more point, which our next speaker will address more fully, but I'll just say when governments run deficits, they are creating future taxes against revenue and spending and diverting tremendous resources from financing the needs of the population. The issues of deficit spending and debt are an inevitable consequence of the state's incapacity to tax the population sufficiently to meet its spending goals. So in conclusion, even if automation were not replacing workers and income in the economy, and even if governments stopped wasteful spending and started spending tax dollars more soberly, if there was no corruption and pandering to special interests, and if governments did not run deficits and carry staggering debt, and even if redistribution of wealth through taxation resulted in equal access to power and influence, the financing of the basic income should not be and does not need to be sourced from taxation and redistribution of personal wealth. What we must do is solve the problem of insufficient purchasing power at its root. We need money, but does that necessarily mean that we need more taxation in order to get it? We can be liberated from public debts and freed from the problems of being taxed nearly to death by having a sound financial system, by monetary reform. Money is a social instrument and medium of exchange that should be managed by society in the public interest. About 100 years ago, Clifford Hugh Douglas argued that issuing a dividend to each person sufficient to have a decent living, a kind of basic income, was justified based on the legacy each of us inherits at birth. His argument was that the earth, with its abundant natural resources and the accrued know-how of technological advancements made since the discovery of the wheel, rightly belongs to each one of us. We have a tremendous legacy that forms the natural foundations of wealth. In a just financial system, money, financial credit I'll call it, would simply reflect this foundation, the real credit, as Douglas called it. Governments, as trustees of society, would exercise their authority to create money for the common good and distribute a dividend, again we'll call it a type of UBI, sufficient to afford basic needs to each citizen. It would be issued as credit for the common good by society instead of being issued as debt for the profit of private banks. With financial reform, we could monetize Canada's natural wealth to justify society issuing a UBI to each person without conditions. There is no reason why society could not directly fund infrastructure, issue loans to business and industry, and fund a dividend. Another speaker in our series, Oliver here, will present more on this aspect of the topic. Society can and should reclaim its authority to issue and manage its own money supply without recourse to private banks, which currently enjoy a monopoly on money creating. Banks wield tremendous wealth and tremendous influence as a result. There's no need to take from Peter to give to Paul. Not one penny of anyone's income would need to be sacrificed to enable each person to sustain themselves. There's enough for everyone to have an income under a corrected financial system as advocated by Douglas Social Credit. Thank you.
So, thank you. And now next we have Yves Jacques.
Hello, everyone. I'm also a fellow Canadian, but I live in the United States now, in Massachusetts. So I was educated in the United States, but my roots are in Canada. First of all, I wanted to just comment on the research that the people have made. It's very interesting, and it would be nice to have a greater research also on the issue of monetary reform. That would couple the two together. It would be very, I think, beneficial to have that. We have good news and we have bad news. The good news is really United States is the richest country in the world. It's richest. We have everything we need. We have the resources, we have enough capacity to produce, to obtain a UBI. It's not the facts are there. And you just look at these stores and you say, the supermarkets are full to overflowing. Every store you go to is loaded with goods and of all sorts. So it's not a lack of real goods that exist. The goods do exist in abundance, and the services as well. So that's the bright side. The sun is shining. As we speak, the earth is it's rain. The rain is going on the crops. There is no problem on the part of the human beings and nature. Nature is there on our side. The problem is, the bad news is that the present debt system that we have in place does not reflect the real physical possibilities that we have available. So here on one side, you have the reality is that the goods exist. On the other side is that the debt burden does not go hand in hand with the universal basic income. Going towards this reality is the United States has the largest debt in the world. So you have this paradox: the largest, richest country in the world with all the goods, and then on the other side you have the largest debt in the world. It's around 60-some trillion dollars according to the statistics. The national debt is 22 trillion. And it's staggering because you think that every person in the United States owes, their debt burden is $68,000 per person. Just 15 years ago, in 2005, the national debt was 8 trillion. Now it's 22 trillion. So it's amazing that we're not alarmed by that. This spiraling, this vacuum of debt that we're just siphoning the income that should be available for the UBI, for any, instead of going towards international financiers, it would go towards the people. And in 2005, the debt burden was $26,000 per person. So you see the rate. When I first, my youngest child was 18 years old. Well, his debt burden was a lot less than my grandson, that he just received a debt burden of $68,000. So where does this money come from? So that's the paradox. How can a country be rich of all sorts of goods, yet the poorest in debt? When we are in debt to someone, it implies that we had to borrow something that we do not have at the beginning, or could not produce ourselves. The fact is that the United States should issue its own currency instead of borrowing. In other words, if the present system today is according to the Constitution, written in 1787, states that the Congress shall have the power to coin money and regulate the value thereof. So here you have it. That was the idea of the intent of the founding fathers, was that the power of creating money and regulating would be in the hands of the federal Congress and not in the hands of private bankers that would control the country's currency, and that's a fact. You know, why should we borrow if we could create it ourselves? You know, that's the argument. The deception is that most people believe that the Federal Reserve is part of the government and that it has some reserves somewheres. The truth is that you may have already heard this said, the United States Federal Reserve System is not federal and it has no real reserves. The fact is that the reserves that they base the money system on is our collateral. It's our goods that exist and in abundance. That abundance we talked about at the beginning, that's really the wealth that the Federal Reserve based the money creation on. Though the American people believe that we are a democratic nation, the Federal Reserve System itself is far from being democratic. The Federal Reserve Board is unelected and is not accountable to anyone. It controls and claims ownership of what should be the nation's money supply at the service of the people for the common good. Instead, there are private owners of central banks, the Federal Reserve, managing the economy of the nation and running the financial system to their benefit. It was a European banker, Mayor Alslam Rothschild, who once said, "Permit me to issue and control money of a nation, and I care not who makes the laws." It was the Founding Fathers' belief that the national government must be the only creators of money. Our Founding Fathers understood the trick of the bankers. We should also clarify the term create. When we use this term, we refer to the process used by bringing money into existence. Money is nothing but numbers, be it numbers in an electronic ledger book or checkbook or dollar bills. Using this process, most banks are allowed to lend out up to 50 times more than they had on deposits. Creating money out of nothing and then charging interest on it. The banks create the principal, but do not create the interest to service the debt. And that's what causes this deficit. So we have to borrow more money in order to pay the interest. So it's this spiral. And for instance, in the United States, when we service the debt, we're just paying the interest. We never pay the capital. So what happens is the capital is just added to the debt ceiling. And the debt ceiling is actually, it was a term that was used in just 4 years after the Federal Reserve was created. And just a few years ago, they stopped using the debt ceiling legislation because it's going to go up anyways. So why make a law to give permission for them to do this debt ceiling? The people of America have become tenants and debt slaves to bankers and their agents. Our children and our future generations will be paying this debt forever. We are now coming to the point that eventually the governments will own nothing. Financial institutions of the nations are enslaving us, and no one dares to say anything. Economic professors, politicians, mainstream media all seem to avoid the topic of money creation, treating it as taboo. During the debate on the debt ceiling in 2013, very little was mentioned in Congress about the problem of the debt money creation by either political party. So it's like it's not part of the debate. Why is it not part of the debate? I find that very interesting. And because the reality is, UBI would be a cinch. The reality is there to me, to my opinion. Pope Francis wrote recently in The Joy of the Gospel, "We have created new idols, the worship of the ancient golden calf, as returned in a new and ruthless guise in the idolatry of money and the dictatorship of an impersonal economy lacking true human purpose. The worldwide crisis affecting finance and the economy lays bare their imbalances and, above all, their lack of real concern for human beings. Man is reduced to one of his needs alone, consumption." And he continues, "A new tyranny is thus born, invisible and often virtual, which unilaterally and relentlessly imposes its own laws and rules. Debt and the accumulation of interest also make it difficult for countries to realize their potential of their own economies and keep citizens from enjoying the real purchasing power." See the parallel? The concentration of wealth is held by a small elite of debt financiers who enjoy unlimited capacity to make money. Governments, who could stand up to these money makers? Can an individual taxpayer influence compare? It is rather criminal that the population gets poor and the banks get richer. The global debt of the central banks today is $250 trillion, an amount equivalent to 3 years of the complete production of the entire world. Thus, the amount of this to central banks having it amounts to the central banks having a $250 trillion lien against society. Can this level of debt be repaid? It is mathematically impossible. When government debts exceed gross domestic product, taxation will never solve the problem of government debt. But what is it that we owe? Numbers, the numbers 250 trillion, staggering wealth is created by central banks by computer keystrokes. Staggering debt could also be canceled by keystrokes. Imagine the hope and prosperity restored if central banks canceled the world's debt. The problem with the present debt system is that the human person is put at the service of money, whereas the money system should be put at the service of the human person. This is a quote from Pope Francis, and this goes very well with the UBI. In the family of God, no one ought to go without the necessities of life. The aim of a just social order is to guarantee to each, according to the principle of subsidiarity, to his share of the community's goods. In order to guarantee a basic income to everyone, we must first tackle the problem of the debt money system and replace it with the government-issued money according to the Constitution of the United States. Otherwise, we will pass the burden of the death grip of debt to our children and our children's children. Thank you very much.
Thank you. And now following, we have Oliver Heydorn.
So my paper is entitled Financing a Basic Income Through the Money Creation Powers of the Bank of Canada. As explained by the Economics, Resources and International Affairs Division of the Parliamentary Information and Research Service in a paper entitled How the Bank of Canada Creates Money for the Federal Government, Operational and Legal Aspects, the Bank of Canada routinely creates money for the Government of Canada by purchasing a certain percentage say 15 to 20% of newly issued bonds or treasury bills. It would appear that this money, which the Bank of Canada creates, is not typically spent into the economy, but is used as a type of insurance to provide for various contingencies. And this is a quote from that particular paper. In June 2011, as part of the debt management strategy included in its 2011 budget, the Government of Canada announced its intention to borrow $35 billion over the next 3 years in order to increase its deposits with financial institutions and the Bank of Canada by about $25 billion, and to increase liquid foreign exchange reserves by 10 billion American. The intention of this prudential liquidity plan, as it is known, is to ensure that there are sufficient liquid assets to cover at least 1 month of the federal government's net projected cash flows, including interest payments and debt refinancing needs. The government justified this plan by stating that liquid financial assets safeguard its ability to meet payment obligations in situations where normal access to funding markets may be disrupted or delayed, and that this supports investor confidence in Canadian government debt, end of quote. So the money creation process employed by the Bank of Canada is quite simple and mirrors the money creation process which, through the private banking system, is responsible for the greater majority of our money supply. Contrary to what many people assume, banks are not borrowers and lenders of pre-existing money, but are rather creators and destroyers of the money that they issue in the form of bank credit. The same holds true for the central bank. Whenever an auction of new government securities is held, the Bank of Canada buys a certain percentage of these securities by creating digital accounting entries in the federal government's deposit account with the bank. This deposit is recorded as a liability of the bank, while the newly purchased security is recorded as an asset on the Bank of Canada's balance sheet. Now, the Bank of Canada, the BOC, unlike many other central banks around the world, is publicly owned. It is a crown corporation, an organ of the state. This means that when the bank purchases newly issued securities from the federal government, the transaction can be regarded as an internal government process. In other words, the government can, in effect, order the BOC to comply with whatever policy requirement it deems appropriate. For example, the federal government, through the Bank of Canada, can, in principle, fund its operations without having to rely on private banks or other investors buying its securities whenever there is a deficit. That is to say, whenever there is a gap between government expenditures and tax revenues. The government is not obligated to sequester the deposits in an account with the Bank of Canada. As noted in the same paper, which I quoted previously, the federal government can spend the newly created bank deposits in the Canadian economy if it so wishes. Furthermore, while there are certainly prudential and political limits to the total amount that the Bank of Canada may create for the federal government, the operational and regulatory limits which apply to private commercial banks do not apply to BOC operations. In the last few years, there has been a very interesting court case playing out between a Toronto-based Canadian think tank, Kmera, the Committee on Monetary and Economic Reform, and the Canadian government. Unfortunately, the Supreme Court eventually refused to hear it, but the case was nevertheless instructive in what it revealed about the current financial operations of the federal government as opposed to how it had operated in the past. According to the Bank of Canada Act, the bank has the ability to to use its money creation powers to make interest-free loans to municipal, provincial, or federal governments for human capital expenditures, such as education, healthcare, other social services, and/or infrastructure expenditures. Indeed, according to Rocco Galati, the constitutional lawyer who represented Comer, that was the very purpose for which the Bank of Canada was originally established. And as he explained at a public lecture, which he gave in 2015 at Toronto City Hall, this is how Canada paid for its World War II activities: the Trans-Canada Highway, the St. Lawrence Seaway, the building of many university campuses, and so forth. Apparently, since 1974, or thereabouts, the government has ceased all interest-free borrowing from the Bank of Canada and has been borrowing instead from private sources, including, of course, private banks. What this means is that the federal government, to take just one example, has been pursuing a financial policy that has unnecessarily cost the taxpayer billions of dollars in interest payments. Payments that could have been avoided had the government continued to rely on the Bank of Canada for its financing needs. Now, what I want to suggest in the context of basic income is that not only can the Bank of Canada fund the federal government's deficit with much lower interest, or merely at the cost of administration, since any profit on loans would go back to the government, there would be hardly any point in charging more interest than is necessary for the government to cover its costs. It could also provide the economy with a steady injection of debt-free or non-repayable credit distributed in the form of a basic income. I, together with the other panelists, maintain that the economy needs a steady injection of debt-free credit. That is to say, credit that does not need to be repaid to its issuer to or on behalf of consumers in order for it to achieve an automatic and self-liquidating balance or equilibrium between the flow of costs and prices that are generated by productive organizations in the economy and the flow of consumer purchasing power that is simultaneously being distributed to people in the form of incomes, wages, salaries, and business dividends. The claim here is that there is a chronic and underlying deficiency of consumer buying power in the economy in the form of income. And then instead of compensating for this deficiency by relying on ever-increasing bank debt for more production, both public and private, whether it be needed or not, or more debt money for consumption in the form of consumer loans, we could substitute a flow of debt-free credit to increase the buying power of consumers to whatever level is necessary to clear the consumer market and to enable retailers to meet all of their costs. If this issuance of non-repayable credit were accounted for in accordance with the existing accounting practice, this would amount to the BOC forever increasing its assets in the form of government securities, which, for all intents and purposes, would never be redeemed. Alternatively, the accounting system could be changed so that the BOC would regard unsold or unsellable consumer production in the country as assets in trust, and the money it creates for the federal government's basic income program as the corresponding liability. All it would be doing is, in effect, monetizing the nation's surplus production. When that production is sold to the consuming public with the help of the basic income funds, both the production and the funds would disappear from the bank's balance sheet. The main advantages of funding a basic income through the money creation powers of the state would be that it would not require juggling with taxation or increased taxation, or selling more government securities to private investors. By avoiding those funding methods, you will necessarily avoid all of the problems with them that were mentioned previously by my two colleagues. The only question that remains is whether, and under which conditions, the creation of Bank of Canada credit and its injection into the economy in the form of the debt-free basic income, which could be referred to as a national dividend, would be inflationary. And that particular concern will be the main subject of the next and final paper in our series. Thank you very much.
All right, thank you. And finally, we have Michael Watson.
Okay. Can you all hear me up the back there?
Yep. Yes.
Very good. So my paper today will be why overt monetary financing of a UBI need not result in demand inflation. So just so you all know, I'm from Brisbane, Australia, so that explains the funny accent. So when one explains to the common person the proposal of a national dividend as a state-created and distributed monetary gift given to all as a credit for the nation's total production, there is one very common objection or concern that people often raise. They think that there is a danger that this will result in inflation or a devaluing of the nation's currency, a devaluation that may even be as bad as the hyperinflation that has recently taken place in Zimbabwe or Venezuela as a result of severe political corruption, incompetence, or foreign interference. But before one can understand why a debt-free basic income is not inflationary, or need not be inflationary, one must first understand something of the economic and monetary theory upon which this suggestion is based, namely Douglas social credit. According to the financial and economic analysis of Major C.H. Douglas, there is under the existing banking and cost accountancy conventions a chronic lack of consumer buying power in the form of income in the economy. That is, if we were to think of the economy as one big industrial machine, that machine is generating costs and prices at a faster rate than it is simultaneously distributing incomes to consumers in the form of wages, salaries, and dividends. This results in a gap between total prices versus total incomes, a gap that is currently being filled with more debt money made available by the private banks, but which could be filled by state credit issued free of debt or the necessity of repayment. This latter option is what Douglas social credit proposes to do in order to fill the gap and to achieve a true financial equilibrium in economic life. Part of the debt-free credit would be distributed to each citizen independently of employment status as a national dividend, and part of it would be used to enable retailers to offer discounted or compensated prices on all goods and services. Excuse me. So with regard to this question of inflation, it must first be made clear that Douglas social credit does not advocate that excessive, indiscriminate, or unlimited amounts of compensatory consumer credit be created and distributed via the national dividend. The amount of credit or money created for the national dividend, as well as for the compensated price mechanism, is calculated to exactly correspond to the aforementioned gap between prices and incomes, and would be debited in accordance with the physical profit. or the total amount of goods and services produced for which no income has been automatically distributed, that has been recorded in a national credit account. This means that the amount of credit issued will only be recorded. The amount of credit issued will only be just enough to fill the price-income gap. No more and no less. Injecting too much money into the circulation would, of course, result in demand pull inflation, and thus great care needs to be taken to avoid making such a mistake. Secondly, there is no danger of the debt-free compensatory state credit piling up and causing inflation sometime down the road, as the new credit is merely a monetization of existing price values which represent the costs of real goods and services for which no income has been distributed through conventional means. The new consumer credit will, just like regular consumer incomes, be cancelled out of existence as income once they are spent. The retailers will use this money to liquidate the costs of production and will pay down revolving lines of bank credit, in which case the money is destroyed, or restore working capital. Such compensatory state credit would actually be counterinflationary in that it would liquidate the cost of goods and services once and for all, rather than the consuming public having to acquire additional debt by borrowing credit and interest to liquidate those same costs. Which thus triggers cost-push inflation. Contrary to what one might suppose, it is actually the current conventional financial system's reliance upon new money in the form of debt and interest-bearing loans from private banks to bridge the recurring gap between prices and incomes that is responsible for inflation, and not the lack of available real goods, services, or materials. This cost-push inflation is triggered by the fact that consumer, business, and government debt has to be serviced, and this servicing further erodes consumer buying power, thus requiring even more borrowing to fill an ever increasing gap in a vicious cycle. This drives up the cost of goods and services, and thus the cost of living. The compensated price, or the idea that some of the debt-free credit needed to bridge the gap, should be issued to retailers in exchange for discounted prices, was introduced by Douglas to partly to offer a further safeguard against any possibility of inflation in a social credit monetary system. The price adjustment mechanism is designed to ensure that the total prices of goods and services would be constantly regulated, though not fixed, to ensure that a dynamic balance is consistently being maintained between the rate at which the final prices of goods and services are coming on the market and the rate at which the consumer incomes, including the national dividend, are being distributed. In this way, an equilibrium between prices and incomes can always be achieved and maintained. In the first place, this debt-free credit would be issued to retailers at the point of sale or their products, so there would be no excess credit lying about prior to the transaction that could entice retailers to raise their prices in response to an increase in the money supply. Secondly, the compensated price discount would lower the purchase prices of goods and services by the percentage determined by the governing price factor or consumption/production ratio. So the corresponding increase in the supply of money would be directly tied to a decrease in prices. Finally, to prevent arbitrary, excessive, or unnecessary price rises, businesses would be required to come to an agreement on an acceptable and just margin of profit to be made on turnover. Although this would not place a limit on the amount of aggregate profit that could be made, it would prevent them from raising prices because there is more money about on account of the dividend. Only the profits which would be made per each good or service sold would be limited via a just price index. Free competition would then determine which businesses would be successful and not their capacity to form monopolies or price rings. So long as prices cannot rise in response to an increase in available money, an increase in the money supply will result in an increase in actual purchasing power and not in self-defeating demand inflation. C.H. Douglas explains this point in his Sydney publication, New and Old Economics, quote, "The relationship of money issued to the goods against which it is issued is completely maintained if prices are in the first place related to costs, and the value of the unit in which costs and prices are computed is consistently related to the changing ratio between production and consumption. The payment for an article from two sources is in operation all over the world at the present time. If I, having a capital of $1 million, manufacture an article of which the cost of manufacture is $5, and owing to economic depression I'm forced to sell the article for $4, I am applying my private store of credit, which I call my capital of $1 million, as a subsidy in aid of a reduction of prices to the extent of 20%. I can go on doing this until I have sold 1 million articles at $1 below cost. Furthermore, I go on doing it indefinitely if my bank will give me an indefinite overdraft." Close quote. Finally, the objection of those who fear that the Douglas social credit proposals to inject new debt-free money or consumer credit into circulation in the economy via a national dividend will result in inflation is most likely due to the common misapprehension or lack of awareness that many of the previously existing conventional methods that have been relied on as a means for providing increased purchasing power would be maintained in a Douglas social credit economy. But that is not all the case. Since new purchasing power in the form of incomes would be provided via the national dividend rather than it being borrowed at debt via private bank loans, the national dividend would be merely replacing the role that private bank loans, excessive production or favourable trade balances play at present in order to provide sufficient purchasing power and fill the gap between prices and incomes. All of these aforementioned conventional methods of bridging the gap, which are inherently inflationary, would have to be prohibited. So I submit that a national dividend, or something akin to a universal basic income, which is funded via monetary reform involving money creation by a national credit authority, can be implemented in such a way as to avoid demand pull inflation by controlling its quantity over time and the conditions of its issuance. Such a dividend funded through monetary policy adjustments will provide a basic income to all without stigma or discrimination based on employment status or disability, but also without robbing Peter to pay Paul via taxation in order to fund it. A national dividend will not only provide financial independence and stability to individuals, but also to a nation and to its government as a whole, because it will allow that nation to exercise sovereignty and control over its financial system in service to the common good. Thank you.
Okay, thank you so much. I guess I'll go ahead and take questions for you guys. Does that work for you?
Sure.
Yeah, okay, all right, great. So let's get started here. We've got Almaz on the way back. Should we do 3 questions at a time since there's so many hands up? Okay. So I'll start on this side. Is that unjust? Is everyone okay with that? All right. So Almaz and you, sir, and you, sir. So these 3 in this corner and then this section, and then we'll go to you guys. Yeah.
Thank you all. I have 2 questions. The first, and forgive me if it was implied or stated, I missed it. Does this system of social credits sit alongside the conventional monetary system, or does it replace it entirely? And second, how does it interact with the currencies of other countries in a globalized economy with trade? Thanks.
All right. And then the next 2 questions, you and then you.
Yeah. First one is, why did the Canadian government change its policy of borrowing money from Bank of Canada to private banks? And the second question is, would the government regulate all goods and service providers to control the price they can charge? And how will it function? Like, I couldn't understand. Some people may want to charge more than others, and the whole thing is not clear.
Great. Thank you.
Hi, I have a question for Michael Watson. It's not like a question, it's more like a comment. I'm from Brazil, and there we have a major program named Bolsa Família, which is a cash transfer program. And we had the same discussion about inflation from the very beginning. And we use that as an example because every real, which is our currency, that we put in Bolsa Família, we actually get more productivity in the whole system. So when we are asked about the basic income, we used to say, oh, but the Bolsa Família, instead of creating inflation, it actually creates productivity. And that's an argument for us to push basic income forward step by step. Because if you start from below, you actually don't need any compensation because perhaps the general goods that this money will purchase will actually enhance the productivity. And we oppose that to Ireland example of the subsidies that all of a sudden was turned into a dividend for everyone.
Okay, great. Let's go ahead and.
All right. I guess. Okay, so the first question I think was, will social credit replace the existing financial system entirely, or whether it would sort of be a parallel system? And I think I would say it would replace the existing system, but it would do so in a way that also integrates many aspects of the existing system. So private banks would still advance money for productive purposes, as they do now, based on their own criteria. What I suppose that the main difference would be that when it comes to putting more money in consumer pockets, rather than relying on the private banking system to create additional money and lend it to people for consumption, or to create additional money to engage in more production, economic growth, mainly as a way of distributing more income rather than for the physical output, that end of it would have to be prohibited. So, and that would also, of course, be necessary to avoid any sort of problem with inflation. So in that case, it would be a complete replacement in that, in addition to the incomes that are normally being distributed in the course of production, the state is supplementing consumer buying power, and then there would therefore be no opportunity or no market for private banks to do that as they do now.
But incomes for productivity would still be.
Yes, yeah. So people still have their wages, salaries, as they do now. This dividend and the compensated price are really meant to supplement the flow of buying power so we can increase it. And then prices and incomes would be in an automatic equilibrium. Your second question had to do with how would this work in a globalized world? And that is a very complicated subject. I would say, first off, that it's necessary to understand it from a social credit point of view. If you had a social credit system in place, there would be no incentive for a country to export more than it imports. So favorable trade balances, which are incentivized under the existing financial system, would no longer be something beneficial for a country to seek after. And so the ideal in a social credit world would be that we would trade only insofar as it made sense in physical terms, right? So if in Canada, for example, there are things we really can't grow, or certain resources we just don't have, which are available in some other part of the world, and that really is the only reason why we should be trading with them, and vice versa. So the ideal is that trade, instead of it being this brutal competition between various countries for an insufficient flow of consumer buying power, would simply be a complementary exercise, where it's goods for goods and would be balanced. I'm confident that, you know, if there is the will, the mechanisms can be designed to ensure that social credit could function at a global level. I mean, we do think, of course, that if one country did adopt social credit, even if they adopted partially, it probably, by that fact alone, would put pressure on other countries to do the same. And yeah, so I don't, it would be difficult to specify, you know, all the various ramifications, but bankers are smart people, and they'll adapt. I'm confident that they'll adapt. Let's see. Question number 3. Why did the Canadian government change its policy regarding, you know, was borrowing this money for infrastructure interest-free or very low rate of interest from the Bank of Canada, which was creating the money, and then it switched to private investors. This was, as far as I know, this is not something that was ever explained by the government. The government never said, we're changing the policy and we're doing it for these reasons. Right? It just happened. And of course, the majority of people in society at that time, as is the case now, aren't terribly aware of where the money is coming from or who's controlling what or what the policy is. So, as I understand it, and some of these things can be debated, and you've got different people with different explanations, but as I understand it, pressure was put on the Bank of Canada, probably by the Bank of International Settlements. At this particular point in history, we're moving away from sort of the Keynesian model into a more neoliberal model. Margaret Thatcher and Reagan were starting to come into prominence. And so the idea was that if you want a sound financial system, you've got to get your money from private sources. Whereas, you know, if you get it from the Bank of Canada, well, can you trust the government not to abuse that power? But if you get it from private sources, we can trust, because they're vested interests, we can trust that you know, they will hold the governments to account. So I think that was sort of the understanding or the explanation that was given. Would you regulate prices, or how exactly does that work? So this is kind of complicated and would take me a while to properly explain, but it's not a question of price fixing. Companies under the social credit model would be free to vary their prices in order to cover costs. So certainly one company could charge more for a similar or the same good or service if their costs were greater. The regulation has to do with a across-the-board discount at a certain percentage, right? And that percentage is based on a consumption-production ratio, the idea being that right now one of the factors which causes or is responsible for costs and prices exceeding corresponding incomes is the fact that CAPEX charges have to be recovered from the public, and as do depreciation and other costs for real capital. And there is no automatic provision in the existing system to credit the consumers, the consuming public, with enough income to meet those sorts of costs. So the dividend is meant to cover, let's say, operational costs, and the compensated price is meant basically to take CAPEX out of prices so that companies will get the money they need to meet those expenditures, but we're not going to charge the consumer for it. Instead, we're going to reduce prices to the same degree that we covered those costs of the producer to the consumer. But within that context, prices are free to fluctuate depending, if one company can do something more efficiently, they'll be able to sell at a lower price, and under competition, then consumers prefer their product at the lower price, they obviously will be more successful. And then there was a question from Michael Watson.
I think it was actually more of a comment.
Was a
So,
comment, okay.
actually, since we only have 11 minutes till lunch, we should try to get even more participation from the audience, if it's at all possible. So now we're in this section, and there are 3 hands, 4 hands, I gotta pick. Oh no. You, and are you? Yeah? Can you guys team up?
4 questions.
Okay, well, okay, do 4 questions quickly. That's great. So let's start back here, please.
Yeah, so I think that the idea of social credit and funding UBI through monetary expansion lends itself to the idea of just creating a totally new currency. So I'm wondering what your thoughts are on the rise of independent digital currencies and the implications for monetary reform.
Okay. Oh, I thought it was you.
Me?
Yeah.
Okay, good. Well, thank you. All right. My question is about political leadership on the issue of monetary system reform. I'm not aware of very many politicians, really frankly, any politicians in the United States that are promoting a substantive reform of the Federal Reserve System to create the money supply and distribute it more equitably to the people. I'm wondering if any of you on the panel are aware of any political leaders, either in the United States or Canada or in any other countries. And if not, what do you think we need to do in order to encourage politicians to take up this issue?
All right.
This might already been responded to Almaz's question, but I'm curious if you took a country like Haiti, which is on the wrong side of globalization, imports almost everything, and just implemented the Douglas system, what do you think would happen?
Excellent. Succinct question. Nice.
I'll try to be succinct as well.
So in addition to the Douglas social credit perspective, which has been represented here, there are other ways of thinking about the monetary system as a source of UBI and debt-free money creation. And I wonder if you have a perspective on those, whether they're converging on a single good solution or whether there are critiques of those. Specifically, to give 2 concrete examples, quantitative easing for the people, which is the idea of in response to the financial crisis of 2008, the government created a lot of debt-free money to bail out bad institutions, and to use the value, put a value judgment on it. People said, well, why don't you just create that funding and spread it out among consumers? A second example would be modern monetary theory, which is growing the economics profession in the US, where economists are saying there's no reason to have unemployment. The government could simply be the employer of last resort using debt-free money. And they present arguments to say why that would not be inflationary, similar to some of the arguments we've already heard. So with those 2 concrete examples, maybe there are others as well. What do you think about that?
Fantastic. So let's take answers, but let's be mindful that this whole section has been neglected, so we want to make sure we get to that too. Okay.
Okay. Evidently the designated question answerer. Okay. So digital currency. Well, social credit has a long history, many decades, and it was a worldwide movement at one point. We have had social credit governments in Canada, in Alberta and British Columbia. In Alberta, they made several attempts to implement monetary reform system or some aspect of it, but each attempt was sabotaged by the Privy Council or Lieutenant Governor General or the Supreme Court or somebody higher. And the justification that was given was that Alberta, being a province, didn't have jurisdiction under the British North America Act to make such changes, which was probably true. So I think that, to answer your question, if there is some way that we can sidestep the system and sort of do it ourselves, sort of start at a grassroots level and sort of build it up gradually, go for it. I'm certainly open to that. We have this problem in the basic income community that, well, you see what's happened with Ontario. They're trying to implement just a pilot project, right, within the context of the existing financial system. And they can't even get that through, right? The government nixed it. So what we're trying to do is even more ambitious. We're trying to get the powers that be to make changes. Now, circumstances like automation and financial crises, the ever-increasing amount of debt may eventually force them to make such adjustments. But in the meantime, sure, if there are other ways where, with technology, of course, all sorts of new possibilities come into the picture, and if it's possible to, at least to some extent, improve people's financial situation by having an off-grid or non-official, non-governmental currency that works on equitable principles, I think that's worth pursuing. Okay, so the other question, monetary reform. Do I know of anyone who is promoting monetary reform? There is a former politician, Paul Hellyer, who was Minister of Defense in Canada, who is very much in favor of monetary reform. He's about 80, I don't know how old he is now, 88 or so. But he does speak at various conferences, and you can find him on YouTube. Apart from him, I don't really know of anyone in particular. You might find very small parties, like I think the Canada Action Party, which he was familiar with. They were interested in monetary reform, but these are very sort of minor, obscure parties. Okay, Haiti. Yes. All right. So I suppose the social credit response to that would be if Haiti has the resources to feed its fiscal resources, to feed its people, to house its people, to clothe its people, then social credit would simply free it from any dependence on foreign financial systems or mechanisms. If they ran their own financial system and made it reflect their physical productive potential, then whatever is they're capable of producing within their own frontiers, there would no longer be any financial barrier. And so it would be like a liberalization, an emancipation for them. That they would be in a position to make real whatever is physically possible, right? One of the axioms of social credit is that what is physically possible, if it's physically possible, it should be financially possible. Finance should just be a mirror that reflects what's going on in the physical realm. It should not artificially constrain or misdirect what we're physically capable of doing. Okay. And the other question here, other ways of thinking, quantitative easing for the people. Yes, well, I think I'm not an expert on quantitative easing for the people, but I think that, as I understand it, it's essentially the same thing that we're proposing. I mean, the national dividend, state or government creation of credit, distributed to the people as a basic income, in the form of a basic income. As at least that part of social credit, as I understand it, would be basically the same thing as what those people who champion quantitative easing for the people are suggesting. So I don't know whether they came to that independently or whether it's something that somebody developed on the basis of social credit. Modern monetary theory. Okay, I do have an issue here. MMT, they have this notion that the government should be the employer of last resort, and with increasing automation, it's how are we going to provide incomes to all these people? Well, we'll just get the government to put these people to work and create the money using state credit, as I suppose, to fund that. Philosophically, social credit, Douglas social credit is completely opposed to that, because from our point of view, we can physically right now provide everybody everything that they need, goods and services, everything that they can use with profit themselves, with only a small portion of the available labor force actually working. So we do not support full employment, right? From our point of view, it makes no sense to insist on full employment when full employment is not physically required to meet our physical needs. And so what we should have instead is minimum employment needed. And it's also quite worrisome, you know, if you have the government as the employer of last resort, what are they going to have people doing? Will we be building pyramids for our meal tickets? Is that, you know, that's pregnant with all sorts of possibilities. And I think people, especially in this country, would prefer, at least in theory, would prefer freedom, right? So we believe in leisure. Social credit would allow people to have that freedom.
Fantastic. Sorry for your neglect. Let's go ahead and take 1, 2, any other hands in this section? 3. Okay, perfect. Right on down the line. Let's go ahead and start with you.
I'm very interested to hear about Douglas and social credit. The perceptions and crazy Douglas. Wacky ideas. Well, I guess they're coming back with a vengeance. I was just wanted to ask, what did you think? What is the relationship between what you're proposing and canceling debt? I think it's been done in South America. The Icelandics did something similar with respect to the World Bank, I believe.
Okay,
What's your
great.
thoughts on that?
Thank you. And then?
Yeah, I was wondering, assuming this theory is correct, from this viewpoint, do you think that advocacy for UBI policy through taxation under the current sort of theoretical paradigm would be a positive transitional step, or would it be counterproductive? That is to say, would UBI through taxation be more or less efficient than what you're laying out?
Great. And?
And then, mostly in response to the last talk, I would like to know how you determine that price-income gap pretty much in real time, and how much of a basic income that would come down to for a single person. And since you said it pretty much fluctuates a lot, how that goes together with the idea that basic income is supposed to be kind of a guaranteed floor. Yeah.
Thank you.
Okay, so the first question dealing with canceling debt. You could say that the social credit proposals actually involve creating debt-free credit for the purpose of canceling surplus or excess debts associated with production. So the idea is that productive organizations have all these costs that they have to meet in order to maintain solvency. And there's not enough income that's automatically being distributed to people, so we always have to try to compensate somehow, whether it's through consumer loans or favorable trade balances or more production, constant economic growth. If instead of all those things you create the money debt-free and you inject it to consumers or on their behalf, then that money is going to be used to cancel out production costs, including debts. So the idea is that, this is a bit of a simplification, but the idea is that there's always a surplus of debt on the productive side. There's insufficient income being distributed to meet that debt. So we're increasing the buying power so that the productive debts and the consumer buying power will equate. Everything can be distributed, all costs met, and and we're not kicking the can down the road by constantly ramping up government, consumer, or productive debt. As far as other solutions are concerned, if the debt does become unsustainable, they may have no choice but to cancel it, as has happened in various places, Iceland and other places. From our point of view, that's what happens when you're not running a system that's in equilibrium, that's fundamentally unbalanced. You keep on getting more and more into debt, and that leads to financial crises and inflation and all sorts of problems. Is a UBI a positive development, or is it counterproductive? I have mixed feelings about this. I think that it could be a positive development in that it would change people's psychology and sort of the culture if people actually were getting some buying power with it not being attached to employment status. I think that would be that aspect of it would be very positive. But there is, I suppose, the danger that people would become complacent and say, well, why do I care about monetary reform, or why do I care about debt-free dividends? I get my tax-based or debt-financed basic income every month, and so we already have that. Why are you trying to sell us something we already have? And so I have some concerns that if we had a conventional UBI, perhaps then people would not, the dissatisfaction with the existing system would be tempered to the point where then more radical change, which in my opinion I think we actually need and will have to confront at some point, may not see the light of day. And the question about the price-income gap and dividend being guaranteed or not. One of the differences between the social credit national dividend versus a conventional UBI is that in social credit, the level of the dividend is not guaranteed. It's a function of productivity, it's a function of the size of the gap, and that of course can change depending on all sorts of factors. This is also, however, an answer to those people who say that if you gave everyone an income independent of employment status, people would stop working. Because under social credit, if too many people decided to loaf, production would go down, and that means then that the size of the gap would be smaller, and there would be less money to distribute in the form of a dividend, and that would be a sort of feedback loop indicating that if we want to live at a higher standard of living, more people have to go to work and provide the needed labor input. Now, assuming then that we're in a cooperative commonwealth and we have some regard for our own interests and the interests of others, I think, barring natural catastrophes, it would be reasonable to expect that in a social credit system, the dividend, while not guaranteed, is something which you could not have to worry about, that it would be fairly steady, generally increasing, and so I think it would be, practically, probably would be guaranteed, but not theoretically. And how do you determine the size of the price-income gap? Well, that is quite a complicated question. We have done some initial statistical work on that, and it seems that in the United States, under the existing system, the gap is, and don't quote me on this because it's more complicated than I can do justice to now, but the gap is at least $3 or $4 trillion. So, if you divide that amongst all American citizens, I think it comes out to something like 7,000 but it's also a question of, are you going to give it to children, or will it be prorated or whatever? I actually think the gap is actually larger than that, but there's so many things we do now to compensate for it that it would be difficult to put an exact number on it. But I feel confident that the national dividend social credit national dividend would provide us with purchasing power that is comparable to what conventional UBI proponents have suggested as their sort of guaranteed level.
All right, well, we're way over, so apparently it's lunch now. I'd like to thank our panelists.